a channel that brings you original behind-the-scenes conversations for the banking and fintech industries.
Hi, everybody. Welcome to the next episode of the Travillian Next podcast. I'm very excited for our guest today, Ben Reynolds, Managing Director and Head of Stablecoins at BitGo and formerly President and Chief Strategy Officer at Silvergate Bank. Ben, thank you for joining us.
My pleasure, Mike. Thanks for having me.
Your coming on is incredibly timely. There's just a litany of news and guidance, and everyone loves stablecoins and crypto again, which, as we know, not too long ago wasn't the case. But hopefully, with today's conversation, we can kind of set the record straight of what some of the risks and opportunities are, and what you're working on, and your experience in the past, if that works for you.
Yeah, let's do it.
So I thought what would be interesting is kind of starting at the beginning. I mean, you were basically employee number one on Silvergate's crypto initiative, which, if I recall, wasn't even really a crypto initiative when it started. I think it was called fintech banking.
That's right.
Can you walk me through just how that came together? You know, novel activities in banking still are pretty new and really not well defined. I'd love to just hear a little bit about how that opportunity came together and evolved at Silvergate.
Yeah. So I started there in 2016, and there was actually some really good work that had been done at Silvergate before I started. So our CEO, Alan Lane, Kate Frayer, Michelle Savins, Chris Lane, they had done a bunch of really good work understanding what the risks were with providing banking services to Bitcoin companies. They had talked to our regulators, 2014, I believe, 2015. And so I started at the beginning of 2016, and the offering was just very, very general and vanilla. There were Bitcoin companies that needed bank accounts, and so it was a full deposit play on our part. So when I got there, we had about 15 clients. At the peak, we had about 1,600 clients. When I got there, we had about 15 million in deposits. At the peak, I think we had 18 billion in deposits,
Sounds about right.
Something like that.
Yeah.
So it was some pretty incredible growth. It was a great time in the sense that there really wasn't a lot of competition. That said, I think one of the things that's underappreciated about the Silvergate story is we had 12,000 prospective customers, and we only accepted 1,600. Right. So we said no to over 10,000 prospective customers in the space. So we really were very diligent in which customers we took on, why we took them on, looking at their compliance procedures and all of those things. Obviously, one of the biggest risks in the area is, BSA, AML. So that's kind of how it got started. It grew, at the time we were a community bank in San Diego, and we really grew so that was our largest business line, really our only business line at the end.
Yeah. It's interesting. I feel like, novel banking strategies, typically don't start with a very it's usually deposit driven.
Yeah.
Even banking as a service, those banks that got into that early, whether crypto banking, it's usually how do I get deposits? And then kind of the offshoots of that are what make the story really compelling or just, okay. And you mentioned the work that was done before you got there with the regulator. Silvergate was a Fed bank.
That's right.
I would say regulatory risk is probably the most significant and unquantifiable risk for investors that are looking at novel banking stories. Can you maybe, best you can, walk me through some of the peaks and valleys of the regulator's view around stablecoins and crypto banking? I'm sure there was a lot of changes from 2015 to the very end, obviously, which we'll get to. But
I think so. There's been a lot of reporting in this area, and I think a lot of really good reporting around Choke Point 2.0. One of my favorites is Nick Carter from Castle Island. He's done a podcast on this, and so there's a bunch of really good information out there. So I'll try not to rehash what's kind of already been said. But I think what's interesting is people looked at Silvergate as sort of this overnight success, and it really wasn't that way, right? I mean, dating all the way back to 2015. But, and your banking audience will appreciate this and know that the regulators come in every year, right? So they came in 2016, they came in 2017, in 2018, 2019, 2020, 2021. And I hate to kind of belabor that point, but as when the regulators come in, they're looking at all of the different aspects of your bank, right? All of the things that go into your CAMELS ratings ultimately. if we had been doing something wrong, I guess what I would say, we wouldn't have been able to have the growth that we had over that long period, right? So
and you guys raised capital on multiple.
Yeah, we went from being a community bank in the private market, with about a $60 million valuation to a public company with a $6 billion valuation at one point. And I think, they're, in their defense, I think they're always looking for safety and soundness. And I think that we were conducting ourselves in a way that was safe and sound. So what started, maybe the part that I didn't cover, was what started as just basic banking kind of turned into something that had more novel products. So what we were probably best known for was this thing called the SEN network, which stands for Silvergate Exchange Network. There was really no exchange that happened. We never custodied the digital assets themselves. It was really just an internal bank transfer. Is what it was, a debit on one side and credit on one side. But this was incredibly valuable to our customers because digital assets trade 24/7, 365, and so people could do these internal transfers 24/7, 365. So to give some perspective there, I think in 2021, our customers did about $720 billion in transfers over the SEN network, on a deposit base of about $10 billion.
Right.
And that might seem like a really large number. It is a really large number. But like our clients were the biggest firms in the space, stablecoin issuers, a lot of the hedge funds that are traditional markets and whatnot. So anyway, there was definitely, to your question on what were the highs and lows, it was definitely an educational process. Certainly the low was at the end when ultimately the board decided to voluntarily wind down the bank. But that was a point of pride for us, right? Because
I think it's the only time in capitalism you'll ever see a bank wind down and everyone get their money back and not a government dollar is needed.
Yeah. I mean, the FDIC never came in. As you said, like all of our depositors got their money back. Our equity holders and our employees and our board, obviously, that it was not as fortunate for all of us, but it is a point of pride that hey, we were able to we managed our balance sheet in a way that our customers were able to get their deposits back.
Well, it's interesting, and you brought up Operation Choke Point 2.0, and I want to get into this a little bit, and we will get to stablecoins and some more positive opportunistic stuff. But I think it's important that we, especially for banks that are thinking about getting into the space again, and I can tell you personally that they're out there, let's learn from everything and be better in the next iteration, right? And that's very common just in life. So what's ironic to me is Silvergate definitely became a bit of a scapegoat, but some of the issues with Silvergate, in my opinion, as an equity analyst that was fundamentally covering the company, they really weren't different than Silicon Valley Bank or First Republic Bank. I mean, it was institutional deposit concentration, right? So that is more fundamental versus novel. I think that there are. Sometimes it's easy to just bucket things all together. But certainly, and what's funny is thinking back, I remember we always used to have the conversation, like Silvergate probably makes sense as part of a larger entity, right? Where it's more diversified. And we kind of but things were going so well, we just pushed it out there further and further. But I guess in hindsight, it really did make sense that you were part of a larger entity that could manage that volatility. But it wasn't just a crypto banking thing. Right. It really was a institutional concentrated deposit customer thing.
That's right. And I think, the first part of what you said there, Mike, I think is really important about, sort of what is the opportunity for the banks that are maybe looking at the space right now. I think it's massive. I think, we always, when we do those analyst calls, one of the questions we would always get is, how do you feel about competition? And what we would say a lot is look, we want more competition. We want there to be more banks in the space because it reduces the overall concentration risk. And if this industry is really going to grow into what we think it could be, you're going to need more than two banks. Right. Really, the only two banks that were at the time that were actively in the space and being public about it were Silvergate and Signature, and then subsequently kind of customers. And that was a problem. And so I sort of, in some ways, look to regulation to say that at the time, banks were so afraid to get into the space that it sort of pushed all of these crypto companies to Silvergate and Signature. And most of our clients had accounts in both, right? Because just historically, this is an industry that's had a difficult time getting banking relationships.
It still is.
And so, I think it's a massive opportunity. The key there with anything, though, if you're a bank, is to really understand what are the risks, that you're taking on, and then build a program to mitigate those risks. And that starts by really understanding the customer and knowing who the customer is, right? Banking and exchange is very different, I should say, than banking a custodian, right? It's very different than banking a miner, which is very different than banking like an institutional investor or a trader in the space. So really understanding who that customer is. You don't have to serve the whole market. You can serve, a portion of the market.
And I think what also is a challenge, though, is if we think really to the catalyst of the issues that crypto banking faced, it was FTX.
Yeah.
Right? And FTX, in hindsight, was a lot of different things.
Yeah.
Right? And very weird corporate structure.
Yeah.
But they had, very reputable real businesses, like a Ledger Prime, and then they had a lot of other stuff that was, in hindsight, maybe less reputable and less, but it was all kind of rolling up. And but my hope would be after that now for new banks, there'd be you still deal with a lot of these companies. Do you find that organizationally, there was some lessons learned from that and keeping things separate, or do you think there's still a lot of companies like that?
Yeah, no, I think there are a lot of lessons learned for sure. And if it's easy to kind of look at it now and say, oh wow, there was this massive fraud, and how did you not catch this? Right?
Yeah.
I mean, that's similar to the Bernie Madoff thing, and Mike Lempress did a couple of podcasts recently too, where it was, Silvergate was a victim of Sam's bank fraud as well, right? And so, but what really happened though there, just to kind of rewind the clock a little bit, is that when FTX, when there was first questions about their solvency, people didn't necessarily know or think that it was fraud. But what happened was everyone in the industry had kind of trusted this guy, and what followed was a crisis of confidence. And so what happened was our customers started pulling back their deposits, right, up to, I think it was 70%, and we fulfilled those deposit redemptions, if you will. But it was just a time where there was sort of risk off in the entire industry.
Yeah.
Some of our clients, they were like, look, Ben, we have a line of credit from a venture firm that has backed us for 10 years, and they're pulling that money back. So it really was this widespread sort of crisis of confidence. Again, I think that it could have been mitigated if there were more banks in the space, and it wasn't concentrated in just these two large players. And so I think that's a lesson that's been learned from the regulators, specifically kind of about FTX. I mean, I think, fraud is a risk. It's always a risk.
Saw commercial real estate loan go bad because of fraud the other day. It happens.
But again, you look at it and you say, we had a due diligence process on all of our customers. And I just come back to, we had 12,000 customers that wanted to bank with us, and we chose 1,600 as our customer base. And that was from the due diligence that we had done and the standards that we kept and all of those things. So, I in hindsight, I don't think that Silvergate could have done anything to prevent FTX and the fraud that was happening.
Right. And what's interesting, well, two things. Number one is the best thing Silvergate probably could have done had nothing to do with crypto banking, and that was trying to hold as much community bank as they could for diversity purposes, right? Which might have helped just have some, I don't know if the sizing would have been that significant at that point, which is the problem. But I think, once again, if the BSA processes were pretty tight, you're moving to non-crypto specific risk reducers, right? Like a diversified balance sheet, which is more generic for any bank versus specific to you.
Yeah. So on that point, though, I mean, I think that was the challenge that we had on that is that, when you grow from $2 billion to $18 billion in the span of, 2 or 3 years, community banking just doesn't grow that fast.
No.
Right. So really what we would have had to have done is we would have had to put some limiters on that business up front to say, hey, we're only going to let it grow to be X% of our business. That's really the only way we could have done that. Like sort of once we got down that path. But we had some novel products, right? Like the Send network that I mentioned,
and the value of the Send really was all the people on it.
That's right.
So if you were turning people away, that value would have been less. It's kind of a chicken to the egg.
Yeah.
It's a little bit of a conundrum.
Yeah. For sure.
What is so we've kind of established that. So the diversity, strong BSA processes. Your view is that the stablecoin and institutional crypto industry has become, and I think this is true in all fintech, there's been survival of the fittest.
Yeah.
Like something like FTX washed out a lot of players that were probably not really a client that a bank would be dying to get, and left the strong, well-capitalized, kind of well-run players. I don't know if that's always universally true, but I think there's been a lot of that. Would you agree with that?
Yeah, that's right.
Yeah. So, risk-wise, I think you come back to this, what is the regulators' kind of view on this subsector of novel banking activities, right? And this is when you get back to the Operation Choke Point 2.0, debanking, all those things.
Yeah.
I think, like you said, it's been covered elsewhere, and that's not really the purpose of our conversation today. But with some of the recent announcements, OCC, there's been some favorable guidance. What's your hunch? I mean, you're probably one of the longest tenured crypto bank people in the industry. Based on what you're hearing from them, and I know BitGo does work with some banks currently, what's your hunch kind of about the direction of this? Is it real, or is it kind of superficial, or too early to tell?
Yeah, no, I think it's real. And I think where it's, and so the Trump administration has obviously been very pro this industry. But I think part of it is because there are novel technologies out there, things like stablecoins, that the U.S. hasn't been leading on, right? You take the largest stablecoin out there, something that's called Tether, that's been around almost 10 years now. Maybe it has been around 10 years. And it's completely offshore. And through that Tether entity, or what a lot of people call USDT, you have about 160 billion of value that's locked in that stablecoin, right? You can think of that as almost like $160 billion of deposits that are in that stablecoin. And that technology exists offshore, right? So if that entity wanted to sell all of the treasuries that are backing that could potentially create a shock to the financial system in the U.S. And so I think the new administration realizes that, in the U.S., like, we want to be leaders with this technology. We want to be at the forefront. We don't want this technology going offshore. And so then that trickles down to the regulators. And one of the analogies I use sometimes, it might be a little bold, but back in the late 90s, right, you were an internet company or you weren't an internet company, right? Today, no one really thinks of themselves as an internet company, right?
Right.
Like everyone has some type of digital strategy, right? And there's business models that were created around that and whatnot. If the blockchain and things like stablecoins have that type of impact on something like payments, I almost envision a world where you're not a crypto bank or not a crypto bank. You're just a bank that's embracing these digital technologies. And you'll have to, almost from a defensive perspective. So I think, that's maybe a very optimistic view, but I think you are seeing that trickle down into the regulators, and you've seen some recent guidance from the OCC and others saying, hey, crypto activity in banks is not, is no longer illegal.
Yeah. Well, so you bring up a great and interesting point, and I think the best way to kind of go down this path around banks, stablecoins, cryptocurrency companies is to go back to Silvergate one more time here, back to the well one last time, because Silvergate was the first bank to try and launch its own stablecoin.
Yeah.
At least as far as I'm aware.
Yeah.
And you guys, and that wasn't a crypto use case stablecoin, like very much like, and maybe what would be great, Ben, too, is as you answer this, to just give a brief introduction to the concept of stablecoins. But like a USDC, a lot of the stablecoins out there, their primary use case today is for crypto trading.
Yeah.
This wasn't the purpose of Silvergate's stablecoin project.
Right.
And so when you look at the payment landscape as a whole, which is essentially a duopoly, which I think in academically in history has never been great for innovation. But you guys can challenge me on that if you want. But companies like Facebook, there are large retailers, and they're all looking to find a way to not pay interchange.
Yeah. And
so, correct me if I'm wrong, but I think that was where a lot of these stablecoin payment-related projects spawned from, and Silvergate was one of them. So it's not really a question, more a long statement that I'm hoping you take somewhere. But
yeah. No, thanks for teeing that up.
Yeah, exactly.
So some people will remember that Facebook was going to launch a stablecoin, and it was going to call Libra.
Yep.
And when they originally were going to launch that, it was going to be a basket of currencies, right? It was going to be the euro, it was going to be the yen, the dollar, and essentially what they were going to do was create the security and use it as a payment mechanism. Of course, they didn't go through the regulatory process in the SEC, and I think David Marcus even ended up testifying in front of Congress on Libra and what it was. So they pivoted, and they pivoted into something that they called DM. And Silvergate was actually going to be the issuer of DM. So you say, okay, well, what does it mean to be an issuer of a stablecoin that essentially Facebook is launching? DM was a consortium that had firms like Uber, Spotify, Facebook in it, these big platforms with billions of users. And so then you say, okay, well, there's a lot to unpack there, right? What was Silvergate's role going to be? Why did Facebook get into this in the first place? And so maybe we'll take those two things separately. So if you think about Facebook, it's a platform that I think has about 3.5 billion users on it, right? Literally half of the
monthly, right?
Half of the world's population has a Facebook account. On the other side of that, you've got Facebook Marketplace that I think has something like 1 million merchants around the globe. If you think about the way payments work across borders, and even across the Facebook platform, there's a lot of friction there, right? It takes time, it takes money, there's a bunch of conversion costs. And so their vision for this was, let's create sort of a universal stablecoin that we can use on the platform. And then when we do that, of course, a firm like Spotify is going to want to offer it to their merchant. Uber is going to want to offer it to its riders and whatnot. And so what we loved about that was they had solved distribution. What regulators didn't like about it was it had this potential to be massively disruptive and huge scale. Think of it as like trillions of dollars potentially coming out of deposits and moving into the reserves of a stablecoin. So that was one of the risks with it. So then, okay, well, what was Silvergate's role? So they were initially going to launch this in Switzerland. The Swiss regulator, who I think was FINRA, was having a hard time getting the United States government to sign off on this, potentially trillions of dollars in a stablecoin in Switzerland. So
we could debate whether that was the right launch point geographically for a project that wanted U.S. regulatory blessing. But that's for a different podcast. Yeah. Tune in next week.
So they decided to move from. They're like, okay, we'll bring it onshore. Onto the U.S., and we'll do it through a bank. And we had convinced them that Silvergate was the bank to do that. And so we went through that whole process. And I think David Marcus has written a blog on this that kind of highlights sort of what that process looked like. But we got all the way to the finish line. And I think the Financial Times reported a piece that it was breakfast between Jerome Powell and Janet Yellen, where they were talking about, they've done everything that we've asked them to do. Should we let them launch? And the verdict from that was no.
Yeah.
And so, unfortunately, that never got off the ground. But that didn't sort of stop our stablecoin ambitions. And so we were actually pursuing. I don't think it was well known at the time, but we were pursuing something that we were calling Send Dollar, or I think as you asked in some of your questions as our analyst, Silver Dollar. We'll never launch Silver Dollar.
I should have traded that.
it was actually a lot closer than maybe you'd think. And it was going to be a stablecoin on Ethereum, initially available just to Silvergate's customers in a closed loop type of system. But it was going to be the first tokenized deposit. And this is back in the 2021 kind of time frame, 2020, 2021 kind of time frame that we were looking at that. So yeah, it's an incredible space, and I don't think we've really seen anything gain traction since then. I mean, obviously Tether has continued to grow, Circle's USDC has continued to grow, but there isn't really a tokenized deposit offering out there today that's at any significant scale.
It's fascinating, and this is maybe the launch point now to get to kind of what the future is going to look like and how stablecoins can play a role in payments and where banks sit in that chain, for no pun intended. So let's talk about lately. So since Silvergate,
maybe we can, if it's okay, Mike, maybe we can define what a stablecoin is just for people really quickly.
Let's do that.
Thanks for watching part 1 of our Travillian Next podcast with Ben Reynolds on stablecoins and the future of novel activities in banking. Make sure you subscribe to our mailing list if you want to enjoy part 2 next week. And as always, follow us on LinkedIn.